Let's stick with the markets and welcome in Kathy Jones now. She is Chief Fixed Income Strategist at Charles Schwab. Good to see you, Kathy. Let's talk about that main event of the week, which is going to be happening Tuesday and Wednesday when the Fed kicks off its policy meeting tomorrow. What are your expectations for that meeting?
Sure, Alexis. Well, what we're expecting is no actual change in policy. So Fed funds rate will stay near zero. The asset purchase program will probably continue at the pace that it's been running for a while now. And it seems doubtful that forward guidance will change very much, although it's going to get interesting with the dot plot to see if there's any shift there. But I think the message from the Fed is going to be that they're still far away from raising rates. There might be a few tweaks. It might raise the interest rate on overnight reserves to deal with some of the excess capital at the short end of the balance sheet. But other than that, it's really going to focus on, I think, what Jay Powell has to say in the press conference, because he'll have to reconcile the improving outlook for the economy with the ultra easy policy that the Fed is maintaining.
What about calls for Operation Twist? Do you think that's something the Federal Reserve will ultimately have to do?
I think it's likely someplace down the road that they could do an Operation Twist because they have a big buildup of assets at the short end of the balance sheet, and they could shift some of that to the long end, especially if they think the curve is getting too steep or long rates are rising too rapidly. I don't think that they would announce anything this soon, but down the road, that's one of the tools that they could use if they thought the rise in, say, 10-year yields or beyond was moving too far and too fast.
You know, I know heading into this year, you had a target of 1.6% on the 10-year yield, and lo and behold, we've already surpassed that, although we're below it right now. How have your targets changed, if at all?
Well, I think we're going to clearly have to move that target up because we got much more in the way of fiscal stimulus than we expected. So when we put that forecast together late last year, we thought we'd maybe get close to $1 trillion in fiscal stimulus, and here we have $2 trillion and talking about more. So I think that it'll probably have to move up. But I do think in the near term, the market's probably going to consolidate here. So we've had a pretty good size run up. Over the last couple of months, we've reached kind of a equilibrium rate that's pretty much consistent with where we were coming into the pandemic or just before the pandemic really hit. And then now we're at a point where real interest rates are moving up, and they're much more attractive to foreign investors because bond yields around the world have not moved up that fast. And so we're looking for foreign investors to step in. Even on a hedged currency basis, these are pretty attractive yields. So I think there's going to be a bit of a balance here over the near term. But as we get out into the second half of the year, if the numbers hold up, we'll probably be looking at closer to 2% on the 10-year.
And what does that do, if anything, to the economic recovery? Does it start to slow it down? I mean, we know the 10-year yield, at least, is tied to lots of loans that we use all the time, including mortgage rates, which have now started to move higher.
Yeah, it will probably affect the most sensitive areas of the economy that are sensitive to interest rates. But even another 40 or 50 basis points from here on the mortgage rates are still historically really low. So I think that the housing market is probably going to cool off a little bit anyway because it's been on such a hot run for a while. And so higher mortgage rates will clearly add to that. But I don't think it's going to be enough to really hurt the economy if we continue to get these growth numbers bubbling up.
At what point, though, does the rise in yield start to sort of steal the thunder from U.S. equities? What level do you think we'd have to hit?
Well, that's the trillion-dollar question right now. I think that we've already seen a taste of some of the froth coming off when we had that bump up in rates that was moving pretty fast. You know, we had a big range in yields over the last couple of weeks. So we're probably already starting to compete a little bit. But I think if you get in the vicinity of 2% on the 10-year, even though it might be justified in terms of the real economy. You're starting to get then corporate bond yields that are maybe 3% plus. You're starting to get things that are competitive with some of the returns that you could get, or at least the yield that you can get in other asset classes. So I think another 40 or 50 basis points may have some impact.
You mentioned corporate bonds. What about, I'm just curious about the appetite for muni bonds right now, given the infrastructure spending we're expecting to come down the pike from the Biden administration.
Yeah, absolutely. Demand has been amazingly strong given the stress that a lot of municipalities were under over the last year. And now we have part of the package that was just passed, the American Rescue Package, actually has money in it for state and local governments to offset some of the costs that they incurred for the pandemic and to help get schools open, et cetera. So that really has eased a lot of the budget concerns at the state and local level. And then if we talk about infrastructure spending on top of that, that also is good for state and local government. So I think that demand for munis is going to continue to be very strong. It's a healthy place, and people are willing to move a bit down in terms of credit quality because that money, that stimulus is coming in to support the market.
I want to switch over to equities here for a moment, and the trend we've been seeing, which is investors moving out of tech, going into value. What does Charles Schwab have to say about that trend? Are they changing their allocations?
Well, I believe our equity folks actually shifted from overweight to neutral in technology a little bit ago because they thought that it was a somewhat overdone trend. And I think that they're sticking with more of a neutral allocation rather than overweight to tech right now. And yeah, if the economy continues to evolve as we expect, then the expectation should be that some of the sectors that have dragged are going to get the benefit now of the reopening and of the fiscal stimulus.
All right, Kathy Jones of Charles Schwab, always good to see you.